Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Mark Devlin, Senior Technical Manager at M&G Wealth. Thank you for joining me today, Mark.
Hi, thanks for having me along.
So could you give us a bit of an intro into yourself and let us know how you got started in the industry?
Yep, I basically got started in the industry back in 1998. I joined a mortgage packaging firm. It was when I was still living down in England. You'll probably learn as I go along. I've lived in a few places around the UK, so I've got a bit of a mix and match accent. So yeah, I was living down in England at the time, and then came back up to Scotland late 2001. Started working in IFA as a sales support. Moved on to various other roles as well in terms of power planning. I've been an advisor as well, ran a business assurance team, and then for the last almost 10 years now, I've actually been in the Pruth, now M&G technical team. So I started on the summer budget back in 2015. So that was a nice, fun introduction to a technical starting then, come in at 9 and then leave at about 11:30 that night. And you're like, I hope this isn't every day, but thankfully it's not like that. So yeah, I've had a fairly varied journey around the industry.
Yeah. Wow. You've run the gambit of different roles.
Yeah, keep trying everything try everything until you find something that sticks. And in the technical team, I get to play about an Excel a lot. So that's a little bit of advice for me. So yeah, it's always fun and games with that.
That's good. So you talked about how you started with a budget in 2015. So we're going to be talking a little bit more about the 2024 budget, the autumn budget, which introduced several changes in impacting tax and pensions. So what are the key takeaways advisors should be aware of, and how might these affect their clients?
Yeah, I mean, I think certainly, in terms of tax, we did see obviously, a few things happen. One of the main ones is pensions and IHT. I'll get onto that in a little bit, but I think, obviously, the increase in the capital gains tax immediately following the budget, or with effect from the budget, was a fairly a big one as well in terms of that. There was effectively overall, I think £40 billion was increased in taxes, and, employers are, obviously, there's been a bit of press about that in terms of, both the minimum wage going up and the employers' national insurance moving from where they start paying it, and also the rate as well. So that's going to be, quite a big hit, I suppose, there come next tax year when that begins. So yeah, those are fairly I think generally expected on the way there. I think one of the bigger ones we didn't necessarily expect was the pensions and IHT issue that I've mentioned there, and that is one that we're definitely getting a lot of queries on in terms of how that's actually affecting clients and what can actually be done with this. And there's a few different thoughts that we've had on that along the way, really, in terms of what people can be doing. I think one of the fundamental things that was actually not necessarily in the announcement, but more with the consultation document, was that they said, that the pensions, since pensions freedoms came along, back at the start of 2015, then, we have seen pensions almost lose their way, if you like, from, becoming, basically a retirement planning vehicle. So you've got enough income during your life to becoming effectively an intergenerational wealth transfer device, really, if you like. And that was stated in that consultation that, they're trying to get pensions back to what they should be about. And we have seen a few people just saying, clients are actually a bit wary about putting money into pensions now, given this change. But I think the important bit here is looking at your pensions. We're butting heads in the team at a meeting that we had towards the end of last year, just to say, how would we look at pensions now? And I think one of the big bits here is, you've got to think about the money people actually need for their retirement. And we're kind of almost terming that as kind of green money, and then potentially amber as a little bit of a safety net on top of that. And I think that's the important thing. When you look at the size of, the average pension pot, it's not very much, and it's not going to last people, their whole retirement. So, I think the fundamental thing is people still need to be funding for that. And obviously, advisors can help with that, with the cash flow modeling, knowing what people actually need. I think, the kind of the people that are having the real kind of issues are the ones that were using the pensions for the intergenerational money, kind of passing that down. And that's almost become, if you like, red money, the money they will never touch during their lifetime. And I think there's probably, kind of planning that arguably needs done around about that now that, the situation is going to change.
Mm. And with shifting tax thresholds and allowances, are there any particular planning opportunities advisors should prioritize before the tax year end?
I think in terms of that, it's kind of, it's almost a standard kind of tax year end makeup that we have going on here. So, your general, make sure you're making use of your allowances, where you can with your pensions and your rises, as well as any, IHT exemptions you can make use of, like your £3,000 that you can then, give away each year, and it's, immediately exempt from your estate, from that point of view. So that's definitely something that could be done. I think, wrapper swapping as well towards the end of the year, especially with, these CGT changes that we've had here, it's definitely a good way to then perhaps try and get your money in the right wrapper. And we have seen a lot of, unwrapped investments over the years, but, that's kind of the situation, and that has changed a bit. But, that's definitely something as well that can be done by tax year end. And then there's maybe a bit of a kind of unique one for this year in terms of tax year end planning. It's the LTA is now abolished, but we still have some LTA protections that people can actually apply for up until the 5th of April. So, people that might want to get fixed or individual protection 2016, those were originally open-ended with no closing date, but when the LTA was abolished, I think that, just drawing a line under that and just saying, right, if you're going to apply for these, you have to do it by the end of this tax year. And similarly as well, for people that were entitled to any lifetime allowance enhancement factors, you normally had quite a few years to actually apply for those, but those all have to be applied for by the 5th of April. And then probably the last bit around about, the LTA, it's just a bit of a reminder really that, people that had, some of the LTA protections that meant you could not contribute anymore, they now can. So people with fixed or enhanced protections, as long as they held that protection before the day of the budget when we were actually told the LTA was being abolished, and that was the 15th of March 2023. And as long as they maintained that for the rest of that tax year, they can now make contributions. So again, tax year end planning for these people, that might be something you then have to have a look at, but then you've probably got to balance that out with the pensions and IHT issue that we know is on the horizon.
Mm-hmm. And insurance bonds are gaining traction amongst advisors. What's driving this trend, and what scenarios might they be particularly beneficial for clients?
Yep. In terms of that, I think, I kind of mentioned it, the CGT rates, that they have now increased. So, that's a bit of an issue that we're going to have here. And arguably now you could say, somebody with, capital gains inside a bond is probably going to be paying less tax than somebody, a higher rate taxpayer, if they're holding those unwrapped, because, the rate of taxation is now 24% for the higher rate. So, yeah, kind of, those changes to rates have been a big driver. But, since 22-23 tax year, really, things have changed. We had a 12,300 annual exempt amount for CGT that year. Now it's £3,000, and it's similar with dividends. Back in 22-23, that was a £2,000 zero rate you could have on your dividends. It's now just £500. So, from that point of view, people are going to be having to pay more tax because, that those limits have come down. So in terms of that, it's exposing more of the unwrapped investments to tax as you go along through either, your dividends coming out or being paid, they're even still paid with the accumulation units. They don't have to be paid to you. So, there is tax there. And, that will then increase that. So I think, that's definitely kind of, some of the main areas we've seen kind of, almost people are saying, bonds are back. I think, for the right client, they've never really been away. And, with bonds, you don't have that ongoing tax kind of a return potential. going through that, the bonds are basically non-income producing. You're only going to have to do a tax return if you trigger gains, that are going to need you to do that. So again, that's definitely kind of another driver on there. And I think kind of, last but not least, in terms of, bonds, if somebody is, a higher rate taxpayer now and expect to be a basic rate taxpayer in retirement, you can have that benefit that the bond's non-income producing. And then by dropping down that tax band, you could then be bringing, kind of top slicing into the equation. You definitely kind of, get a fairly big head start there in terms of, what tax you're actually going to pay.
Mm-hmm, mm-hmm. And how do insurance bonds compare to other investment wrappers when it comes to tax efficiency? And what common misconceptions should advisors be aware of?
Yep, this is definitely kind of, one where I think, that there can be a lot of misconceptions really around about investment bonds. So, I think, but generally speaking, I think a higher proportion of people now are going to have less tax to pay if they have their investments inside, a wrapper such as a bond rather than holding them directly. I think, that kind of lever has now moved with the changes we have actually seen to capital gains tax. So yeah, I think when you go through the number analysis on it, which we do quite a lot in the technical team, you can then see, for a lot of clients how that can actually change. But I think one of the things as well, it depends really on the makeup of the fund or the funds that you're actually invested in. So, from that point of view, there can be, a great degree of tax efficiency inside bonds. Offshore bonds, they grow effectively free of tax. You're then just paying tax when you're actually, taking the money out. But onshore bonds as well, one thing that sometimes gets missed out is that dividends received inside a fund in an onshore bond are exempt from tax. So effectively, you're getting tax-free dividend growth in there. So I think, that definitely can help as well in terms of, factoring in the overall tax that you pay. The other thing that you can then do with, money inside a bond is you can actually rebalance a portfolio with no tax to pay. That's become much, much harder to do, with unwrapped investments. If you've got a portfolio of OICs that you're invested in for the different asset classes, then trying to rebalance that now with, just a £3,000 CGT annual exempt amount is then going to be quite difficult. So yeah, I think that's kind of another big thing in there. And in terms of, some of the kind of, the misconceptions that we actually, do see, I think, one of the ones I've just kind of alluded to there is, a lot of people think bonds are just taxed at 20% internally, but that's not the case, because, if you do have dividends in there, your internal rate of taxation is going to be less than 20%. But the handy thing with an onshore bond is you actually get a basic rate credit. So you might not be paying 20% as you go, but you get a 20% credit when you actually come to encash it. Top slicing as well, that's kind of a very incredibly kind of valuable thing when you come to taking the money out of investment bonds. So, you could actually have, somebody, if they actually, had £1 million gain in an onshore bond and held it over 20 years, if they come to a point, where they're about to retire or maybe have retired and can, be in a point where they have no other income tax, so maybe they're in drawdown and their state pension hasn't started, they could turn that off. They could have £1 million gain and they would have no income tax to pay for an onshore bond. Even with an offshore bond, if you've got no kind of other income, you can get up to £18,570 out of a gain each year. That's just a gain, not the actual amount you could actually get in your hand. So I think that's definitely something that can be kind of viewed on there. And I think some of the other things, you just get people thinking bonds are old-fashioned and inflexible in terms of that. I mean, they're far from it really. And you do have quite a great degree of flexibility. You can assign out segments and things like that to your loved ones, your grandchildren, things like that, and they can make use of their allowances. Offshore bond is often viewed as being more complex and expensive, and that's not really the case anymore these days. And with the offshore investment, it's basically you put the money in there, it grows tax free, and then when you come to take that money out, you will have tax to pay. But there are easy ways to calculate that, and we do have tools on our Tech Matters website that can help working out all these kind of things. And then I think one of the other main bits that sometimes gets kind of missed out with the bonds is, you don't really have that ongoing tax return basis, unless you are bringing out gains, but you can still get out 5% of your original investment each year up until, you've effectively had your original money back without having any further tax to pay at that time. It is deferred, so, eventually it will catch up to you. But if you have then dropped down a tax band, then, you definitely can make use of, all the kind of advantages they can give you.
Mm-hmm. And what resources or tools does M&G offer to help advisors navigate tax year-end planning and better support their clients?
Yeah, I think in terms of that, I'll kind of just stick on the bond side here. You wouldn't believe I'm a pensions technical manager with all I've just said on bonds there. But, from that point of view, we have been running kind of a bond school, we're calling it, in terms of, trying to, help advisors understand, some of these pros and cons of bonds. And that's just currently running as we speak. We do have kind of my colleague Barry Dawson, he's running sessions 001 to 006. I think you can see where we're going with this joke in terms of our bond school there. But yeah, and on the 20th of March, he and my boss, Les Cameron, will actually be doing a Bond School 007. So I don't know if there's going to be a bit of international espionage in there, or if it's more of a wrap-up session just to remind people. But yeah, I mean, that's definitely one, that I think will be, kind of a good thing to either attend, if you still want to, if we're still going to the sessions, or they will actually be available on our Tech Matters site as well. So you can then, just dip in and out of them at your leisure to actually then go through those. So yeah, they'll be really helpful with that. And then I think in general, we do have our tax year-end hub, as well as, our Tech Matters pages that have got, kind of very helpful information in there around about, what you can do for tax year-end planning. And, I've also mentioned as well, we do have a raft of tools and calculators on there that can, literally with some of these, if we're doing the sums manually, it would take, people, technical people kind of, about an hour, some of the sums we can actually do with those tools and calculators, and they will do them for you really quickly and easily. And, you can then have something on your file just to show, how that's all been worked out.
Okay. And are there any recent regulatory or legislative updates that impact or that could impact advisors' tax and pension planning strategies in the coming months?
In terms of that, there's nothing on the near horizon in terms of that. The kind of, I suppose, the closest thing we've got is a spring statement is due this month. And, we've been told, that is not going to be a fiscal event. So it should really just be a statement. I mean, we will be keeping an eye on those things when they come through. And, if there is anything kind of, big ticket in there that we need to get out there, then I think we'll probably be organizing some kind of WebEx within, 24 hours to actually get information out on that. On the medium-term horizon, this pensions and IHT consultation, that's one we've been told we're going to get a response this year. And I think kind of what I've been hearing, it seems like it's going to be more likely later this year. So again, that's something to keep an eye on. We don't know the full, mechanics of how this is going to work. So it's definitely one to keep a watching brief on. Are we still going to stick with them being, fully in the IHT remit? Or, are we going to see potentially kind of, standalone tax charges coming back like we used to have prior to pensions freedoms to kind of almost be like an IHT charge? So yeah, the exact mechanics, we don't really know that yet. The only thing I think we can say with any degree of certainty on that is, pension death benefits aren't going to be as good as they presently are come 2027. So that's something, just to keep an eye out. And then, with the other thing, we just, keep a kind of watching brief generally in terms of, if anything comes out. So, if anything does happen on that, I'm sure we'll be out shouting about it if there is kind of, any other kind of event that just seems to happen along the way.
Mm-hmm. And finally, with tax year end fast approaching, which we've mentioned multiple times, what are your top 3 practical tips for advisors to ensure they're making the most of available opportunities for their clients?
I think in terms of that, it goes back to what I was saying a bit earlier, make use of the allowances that the client can, for their ISAs, their pensions, their IHT allowances as well. Get the wrapper swapping done. I think that's definitely, something there. And, there is obviously support out there. We're not the only technical team, out there, but, there's definitely, a lot of resources there. We've also got a LinkedIn group that people can actually join. It's I think it's M&G Tech Matters in terms of, the name on that. So, if people do then have questions, they can pop those through. And then I think about the other thing, we kind of quite often seem to have a focus on tax year end and, trying to get things done, almost, rushing at the last minute. And I'm just as bad as anybody else because I'm still trying to get all the pages we've got updated for, the tax year end or the tax year start. I think that tax year start is sometimes where we can actually kind of, miss things on here. Quite often a lot of planning sometimes is left a bit late in the tax year, but with things like wrapper swapping or getting the money into ISAs, getting that in at the start of the year, you're saving your client tax potentially, as opposed to having that sitting in a bank account, paying interest. If you can get that in an ISA, it's all nice and tax free. So again, that's definitely something to focus on. That I think right, tax year end, yep, that's been and gone. Tax year start, and effectively we go again.
Mm-hmm. Well, thank you so much for speaking with me today, Mark. I think this was a very informative episode.
Oh, thanks very much for having me along again. So yeah, it's definitely been good, I think.
Yeah.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.